On July 15, 2026, part of Wall Street's machinery quietly changed gears. Real stocks, ETFs, and U.S. Treasuries held inside America's central securities infrastructure were converted into blockchain tokens and used in live production transactions. These were not crypto tokens designed to imitate stock prices. They were not unofficial wrappers issued by an offshore trading platform. They represented real security entitlements already held at the Depository Trust Company, or DTC, with the same economic rights and investor protections as the conventional version. The surprising part is that the underlying securities did not really go anywhere. What changed was the system used to record and move the rights to them. To understand why that matters, we need to start with DTCC, the Depository Trust and Clearing Corporation. When most people picture Wall Street, they imagine an exchange matching buyers and sellers. But matching the trade is only the beginning. After you press buy, someone must confirm what each party owes, combine offsetting obligations, move the money, update ownership records, handle dividends, and make sure one firm's failure does not break the chain. DTCC and its subsidiaries perform much of that hidden post-trade work. The National Securities Clearing Corporation handles clearing and netting for many trades. DTC holds securities and records entitlements for banks and broker-dealers. In 2025, DTCC's subsidiaries processed securities transactions valued at roughly $4.7 quadrillion. Its depository subsidiary provided custody and asset servicing for about $114 trillion of securities. So when DTCC experiments with a new database, that is interesting. When it puts real assets into a production blockchain workflow, the stakes are much higher. Now let's follow one security through the tokenization process. Imagine a bank has shares of the Invesco QQQ ETF credited to its account at DTC. That bank is not holding paper certificates in a vault with its name printed on them. It holds a security entitlement recorded through DTC's book entry system. The bank sends a tokenization instruction. DTC checks that the bank has an approved wallet, that the asset is eligible, and that the instruction passes its existing risk controls. If everything checks out, DTC removes those QQQ shares from the bank's normal account and credits them to a special Digital Omnibus Account. Think of this as a locked inventory compartment. The shares inside cannot also be transferred through the conventional system while their tokenized versions are circulating. DTC then mints tokens representing the bank's entitlement and sends them to its registered wallet. One entitlement moves into the digital compartment, and one corresponding token appears on the blockchain. That one-for-one relationship prevents the same share from being spent twice. A system called LedgerScan watches the approved blockchains and records which registered wallet holds each token. For these tokenized positions, that record becomes part of DTC's official books and records. The legal structure underneath remains familiar. The securities remain registered in the name of Seed & Company, DTC's nominee. The participant continues to hold a security entitlement under the existing framework. The tokenized and conventional forms share the same CUSIP identifier and carry the same economic and ownership rights. So this is not a digital receipt issued by a random company. It is DTC changing the format in which it records an existing entitlement. That also explains one of the biggest misunderstandings. These tokens are not permissionless bearer assets that anyone can send to any anonymous wallet. Transfers are restricted to wallets registered through DTC participants. The smart contracts include compliance controls, and DTC can freeze, force transfer, claw back, mint, or burn tokens when necessary. That sounds very different from Bitcoin, because it is. This system is designed for regulated securities, where courts, sanctions, mistakes, corporate actions, and lost credentials still exist. Blockchain is being used as a shared transaction layer, not as a way to remove every institution with authority. If you enjoy explanations that separate the actual mechanism from the crypto headlines, subscribe. There is going to be a lot more overlap between traditional markets and blockchain, and the details matter more than the buzzwords. So what did institutions actually do with these tokens? One workflow was delivery versus payment, usually shortened to DVP. In a securities trade, one party has the asset and the other has the money. The dangerous moment is when one side has transferred, but the other side has not. With tokenized assets and digital cash, the exchange can be made conditional. The system releases the security only if it also releases the payment. Otherwise, neither transfer completes. That is often called atomic settlement. There is an important limitation here. DTC's tokenization service records and controls the securities entitlement. Under the preliminary model authorized by the SEC staff, the cash side of a DVP transaction happens away from DTC. Other networks, payment assets, and applications must coordinate that leg. The July 15th event included DVP transactions involving equities and U.S. Treasuries exchanged for digital cash. It also included delivery versus delivery, where one tokenized security is exchanged for another instead of for money. Then there is collateral. Large financial institutions constantly post assets to secure obligations. A firm might need to send collateral to a central counterparty because market prices moved and its margin requirement increased. Traditionally, suitable assets can be sitting in the wrong account, at the wrong custodian, or inside a system that is currently closed. During the production event, JP Morgan used tokenized assets to satisfy margin requirements with CME Group. The interesting feature is not that the collateral became more valuable. It became easier to identify, control, and move through an approved digital workflow. Tokenization can also support a pledge without necessarily creating a normal sale. The blockchain can record that an asset is encumbered and cannot be reused freely until the obligation is released. Faster collateral movement could reduce the amount of extra inventory firms keep available, simply because transfers take time. A related use case is the repo market. In a repurchase agreement, one party transfers securities, often treasuries, for cash and agrees to reverse the transaction later. It economically resembles a secured short-term loan. Putting both the treasury entitlement and the payment asset on programmable rails can make the opening and closing legs easier to coordinate. Securities lending follows a similar logic. One institution temporarily transfers securities to another, usually in exchange for collateral and a fee. A programmable system can connect the initial delivery, collateral conditions, and eventual return. It does not eliminate credit or market risk. It can reduce the number of disconnected records used to manage that risk. The live transactions also involved more than one blockchain. Conversions occurred on DTCC's private network based on Hyperledger Besu and on Canton, a public network designed for regulated finance. Cross-chain interoperability does not have to mean sending a token through an uncontrolled bridge and hoping an identical copy appears safely on the other side. DTC's service design allows a participant to request a chain conversion. The original token is burned on one approved network. Then a new token is minted into a registered wallet on another. The entitlement remains one entitlement even though its blockchain location changes. That controlled burn-and-remint model is less flashy than a permissionless bridge. It is also much easier to reconcile with the rule that only one valid representation of the security can exist at a time. So why call July 15 a production milestone rather than another blockchain pilot? Because the transactions used real DTC custodied assets in a production environment, and DTC's systems recorded the resulting tokenized entitlements. More than 30 institutions and technology providers participated across workflows including equity trades, treasury repo, securities lending, collateral pledges, and central counterparty margin. But production does not mean the entire U.S. market is now on-chain. The transactions were deliberately limited and conducted over several hours. The broader DTCC tokenization service is still expected to launch in October 2026. That distinction matters. July proved that the machinery could process selected real transactions. October is supposed to begin turning that machinery into an available service for eligible participants. There is still a lot to solve before this becomes routine. DTCC must approve networks and token protocols that meet its standards for security, resilience, governance, observability, and transaction reversibility. Participants need registered wallets, sanction screening, institutional key management, and clear responsibility when customers are involved. Corporate actions also need to work. A tokenized share still receives dividends, participates in reorganizations, and may carry voting or distribution rights. In some cases, the preliminary service may need to convert a tokenized position back into conventional book entry form to process an event. The cash side is another challenge. A tokenized security does not create atomic settlement by itself. Banks and market platforms need compatible forms of digital cash, plus legal agreements explaining when payment is final. And faster settlement is not automatically better in every situation. Traditional clearing systems net thousands of obligations together, dramatically reducing how much cash and securities firms must move. Settling every trade instantly could remove some counterparty exposure while increasing liquidity demands. The likely direction is a mixture of real-time movement where it helps and traditional netting where it remains efficient. That is the real significance of DTCC's blockchain switch. Wall Street is not replacing the legal system with code or putting the stock market onto a giant public crypto exchange. It is testing whether regulated ownership rights can move across programmable networks without becoming unofficial copies or losing the protections of existing market infrastructure. The security remains familiar. The record becomes portable. And once assets and payment can interact through shared rules, collateral and settlement stop looking like separate back-office processes and start behaving more like connected software. If you have a question about tokenized securities or want us to explain digital cash, repo markets, or atomic settlement next, leave it in the comments.